Before we jump in, I do earn a referral fee when you use the services and companies I demonstrate in the video, but there is no additional cost to you. I chose them because they're the best in the industry and you're safe with them.
Ever wondered what an S corporation is and how it affects your taxes? Well, you're in for a treat. Today, we're diving into the fascinating world of S corporations. Picture this, a unique corporate structure that combines the limited liability of a corporation with the tax benefits of a partnership. That's an S corporation for you. Throughout this video, we'll be unpacking the complexities of S corporations, from their definition to the tax implications, benefits, and drawbacks. We'll take a closer look at how this special type of corporation works and why it might be a smart choice for your business. We'll also delve into the nitty-gritty of tax laws and strategies related to S corporations, helping you navigate the intricacies of corporate finance. Whether you're a seasoned business owner or just starting out, understanding S corporations can be a game changer. Keep watching to get a step-by-step understanding of S corporation and its tax implications. Now let's delve deeper into what an S corporation actually is. An S corporation, often abbreviated as S corp, is a unique type of corporation that draws its name from Subchapter S of the Internal Revenue Code. It's a favored choice of many small business owners because it combines the limited liability protection of a corporation with the tax benefits of a partnership or sole proprietorship. So, what sets an S corporation apart from other business entities? An S corporation has a unique tax structure that allows it to avoid double taxation. In a traditional corporation or C corporation, profits are taxed at the corporate level and then again when they are distributed as dividends to shareholders. In contrast, an S corporation's profits or losses pass directly through to its shareholders' individual tax returns. This means that income is only taxed once at the individual level. Now, becoming an S corporation is not as simple as flipping a switch. There are certain requirements a business must meet. First off, it must be a domestic corporation or a domestic entity eligible to be treated as a corporation. It must not have more than 100 shareholders, all of whom must be U.S. citizens or residents, and it can only issue one class of stock. Furthermore, certain types of businesses, such as insurance companies and certain financial institutions, are not eligible to be S corporations. And of course, the corporation must elect to be an S corporation by filing Form 2553 with the Internal Revenue Service. As you can see, an S corporation is a unique blend of corporation and partnership. It offers the benefits of limited liability protection and avoids the double taxation that can come with a traditional corporation. But it's not for everyone. It has strict requirements and limitations that may not suit every business. Understanding what an S corporation is the first step to making an informed decision about your business structure. With a clear understanding of what an S corporation is, it's time to explore how it impacts your taxes. Let's dive into the tax implications of an S corporation, a topic that may seem daunting at first, but fear not, we'll break it down into digestible chunks. An S corporation is known for its pass-through taxation structure. This simply means that the corporation itself is not liable to pay federal taxes. Instead, the income or losses are passed through to the shareholders who report this on their personal tax returns. So let's say you own an S corporation and it makes a profit. The profit filters down to you and any other shareholders, and each of you reports your share on your personal tax return. The same applies if the corporation makes a loss. This loss is divided among the shareholders and can be used to offset other income. Now, this pass-through taxation is a double-edged sword. On one hand, it can be a boon as it avoids the double taxation that regular corporations face. On the other hand, it also means you're personally liable for the corporation's tax debts. And then there's the self-employment tax. If you're familiar with sole proprietorships or partnerships, you'd know that all profits are subject to self-employment taxes. However, with an S corporation, only the salary paid to the employee owner is subject to employment tax. The remaining income is treated as a distribution, which is not subject to self-employment tax. This could potentially result in significant tax savings. But remember, while the tax structure of an S corporation can provide significant benefits, it's not all smooth sailing. It requires careful planning and diligent record-keeping. And any mistakes in tax filing could result in penalties or even loss of your S corporation status. As you can see, the tax implications of an S corporation can be quite beneficial, but it also comes with its own set of challenges. While the tax benefits of an S corporation might seem attractive, it's important to weigh the pros and cons. Let's dive into the advantages first. One of the most significant benefits of an S corporation is the liability protection it offers. When you form an S corporation, you're creating a separate legal entity that shields you from personal responsibility for the company's debts and liabilities. This means that your personal assets are safe even if your business runs into financial trouble. Another major advantage is the tax savings. An S corporation doesn't pay federal income taxes. Instead, the company's profits and losses pass through to the shareholders, who report them on their own tax returns. This avoids the double taxation issue faced by C corporations, which are taxed at the corporate level, and again when profits are distributed to shareholders as dividends. Now let's not ignore the potential downsides. There are certain limitations when it comes to S corporations. For instance, they can have no more than 100 shareholders, all of whom must be U.S. citizens or residents. Also, S corporations can only have one class of stock. This can limit the corporation's ability to raise capital and might not be suitable for businesses looking to attract a diverse range of investors. Furthermore, establishing and running an S corporation can be more complex and costly than other business structures. There are specific requirements to meet, from filing the necessary paperwork with the Internal Revenue Service to maintaining accurate records and meeting certain management criteria. Finally, it's worth mentioning that the tax advantages of an S corporation can sometimes be a double-edged sword. While the pass-through taxation can save money for profitable businesses, it can also mean that shareholders are personally liable for the corporation's tax debts. Knowing these pros and cons can help you determine whether becoming an S corporation is the right move for your business. So, we've covered quite a lot about S corporations and their tax implications. Let's summarize. We started our journey by introducing the concept of an S corporation, a unique entity that combines the limited liability advantages of a corporation with the tax benefits of a partnership. It's a special type of corporation that's created through an IRS tax election, offering a unique avenue for business owners to navigate the often complex world of corporate law and taxation. We then took a deep dive into the tax implications of an S corporation. Unlike traditional corporations, an S corporation is not subject to corporate income tax. Instead, the corporation's income, deductions, and credits pass through to shareholders who report this information on their personal tax returns. This pass-through taxation allows S corporations to avoid the double taxation issue that's often associated with traditional corporations. Next, we ventured into the world of pros and cons. On the positive side, an S corporation offers limited liability protection, tax savings on self-employment tax, and the ability to write off startup losses. However, it's not all sunshine and rainbows. There are also drawbacks to consider, such as the requirement for all shareholders to be U.S. citizens or residents, and the limitation on the number of shareholders, which is capped at 100. In wrapping up, it's essential to remember that every business is unique, and what works for one may not necessarily work for another. The decision to become an S corporation is not one to be taken lightly. It requires a careful analysis of your business's current situation, future plans, and overall tax strategy. And while we've provided a broad overview of S corporations and their tax implications, we highly recommend consulting with a tax professional before making any decisions. They can provide personalized advice based on your specific circumstances and help ensure that you're making the best choice for your business. Remember, the decision to become an S corporation should be made after careful consideration and consultation with a tax professional. Thanks for watching.